let's now move to our special guest of the day. As you know, 2015 has started on a very nervous note. In fact, just yesterday, the World Bank lowered its global growth forecast for this year as well as next. And then, of course, we've got that big unwinding going on in oil prices, which are currently trading near 6-year lows. That's a positive for countries like India, but not necessarily across the world. Will 2015 be a year of uncertainty? We've got a special guest to answer that question, Dan Houston, President and CEO of Principal Financial Group, joining us this afternoon to talk about his worldview. Dan, good afternoon. Thank you very much for speaking with us. Let me start by asking you whether you think 2015 is going to be a definite improvement on 2013 and 14, or are you feeling very cautious at this point?
Well, I think we'd all be very well served to continue to be cautious. 2014 was certainly a good year here in India with the markets up over 30%, but we've got some favorable tailwinds right now, don't we? We have the benefits of lower oil costs. We have the benefit of a prime minister who's very enthusiastic about pushing through some reforms to ignite the growth here in India. So I think all in all, we'll end up being pleasantly surprised by 2015.
Will India and the US maybe be two of very few growth spots in the world? Will the fears with regards to the deflationary pressures in Europe and in Japan outweigh the growth prospects in emerging markets like India and, of course, that big global engine of growth, that's the US?
Yeah, it's a really good question. And you know, we were only speculating at this point in time, but clearly there is a lot of economic prosperity going on here in India as well as in the U.S. I think the Latin American economy continues to improve. We've seen some softening throughout Southeast Asia, but I think all in all, you know, the net on global growth this year is going to be pleasantly surprising for us. And I think, again, one of the drivers of that is going to be low oil prices and also the seeking of alternative energy sources from around the world, and certainly without as much consumption.
Lower commodity prices, Dan, good for countries like India, but certainly going to have the impact on other parts of the globe. How long can India be insulated from that?
Well, you know, you're right. I mean, it's a global society that we live in today. The markets are very interconnected. But I'd go back to the 08 and 09 timeframes when the U.S. was certainly suffering through some of its worst economic times of all time. And yet, if you looked at Latin America, the Latin American economies did just fine. So, again, if you just think about the macro issues going on around the world, we have a growing population. We have generally recovering economies. We have banks getting better capitalized, you know, year by year. And, again, the demand for consumers continues to remain quite healthy around the world. And with the exception of a few pockets of some deflationary environments, it seems, again, to be quite positive all in all.
Flows, Dan, how are flows going to be? As we were pointing out earlier in the show, we've seen the 10-year yield in the U.S. drop to 1.87%, clearly a flight to safety. So is that going to affect flows into emerging markets and India in particular?
Yeah, you know, I think this is likely to be temporary. There just seems to be a little bit of pressure right now, as you say, to flight to quality. That certainly is the U.S. dollar and treasuries, as you say, pushed down below 2%. I remember just a year ago there was much speculation that it would be a U.S. Treasury rate, a 10-year Treasury rate, much closer to 3% than 2%. So I think we're all just a little bit surprised. I think we should be reminded of how sensitive the markets have become. There's more volatility. But I think any sort of movement towards the U.S. could be, in fact, relatively temporary as we you know, continue to see how the rest of the world sorts out over the course of the next first and second quarter of 2015.
Dan, how are you interpreting this U.S. 10-year yield, or the message coming in from the bond market? Is it an interpretation of you know, maybe the assessment that the Fed will really not make any hasty steps towards increasing rates, or is it that, you know, the bond market in fact believes that consumption is going to be sluggish in the U.S. and therefore with, you know, the kind of weak inflation that we've seen both in the U.S. and of course much weaker in Europe, you know, rising rates is not a scenario that we need to confront anytime soon, definitely not in 2015.
Well, that certainly seems to be the bias today, that the Fed is unlikely to make any changes. I think, again, Chairman Yellen has been very careful, along with her deputies, ensuring that the recovery in the U.S. continues to progress upwards. As you know, we're not incurring any sort of inflationary pressures in the U.S. at this point in time. Wages are kind of in that 2.5–3% increase estimates for 2015, and overall cost of goods, overall broader CPI is still quite modest. So at this point in time, there's really not a reason for the Fed to think that they have to intervene and increase interest rates anytime in the near future. I think there's also a little bit of sensitivity to the jobs recovery, meaning we have relatively low unemployment, certainly down from where it was 5 years ago. But there's a question of whether or not we have a large percentage of the population potentially underemployed from what their real contribution could be. So again, I think we have to sort through that. If we look at the number of actual jobs that are directly impacted by lower energy costs, that's not a huge number, perhaps 20,000 to 30,000 jobs directly impacted as a result of lower oil prices. But as you know, that can cascade down into other service and support areas that would have otherwise serviced the oil sector.
Dan, as a global business leader, are you feeling confident enough, given everything that we've just discussed, to expand or invest in 2015, or will it still be a year, as you pointed out, that you will play very, very cautiously?
We view 2015 as another solid year for the Principal Financial Group to deploy capital, looking for acquisitions, looking to, of course, make investments in countries like India. Earlier this week, I was in Pune dedicating some additional space. We now have over 870 employees in Pune, providing a great deal of support for our businesses around the globe. So I don't anticipate holding back at all. Here in Mumbai, we've had meetings over the course of the last couple of days talking about our growth of our advisory business here, along with growing our mutual fund, launching additional products throughout 2015, emphasizing asset allocation solutions and risk-based products. So frankly, we couldn't be more optimistic about the opportunities that present themselves here in India.
You're interested in the insurance space. I'm going to ask for your comment on the way you see India having gone about increasing its foreign investment limit in insurance. We failed to be able to get that approved by the Parliament, and therefore we have an executive decision by the government that's currently up the limit. But of course, this will eventually need parliamentary approval. What's your view on the insurance sector here?
Well, our view primarily around the world is asset management and asset accumulation. Our insurance markets, our insurance businesses are confined to the U.S. market. And in the U.S. market, we use our insurance products primarily to support small to medium-sized businesses for business owner executive solutions, as well as non-qualified deferred compensation. Having said that, I think any time that you can get foreign investment in a country, you're bringing in additional fresh investment dollars. It helps potentially bring in new products. It brings in a sense of energy, enthusiasm, new products, new direct channels possibly, new technologies. So again, I think you have to embrace non-domestic players to come in and make those investments in your local markets.
On the asset management or mutual fund side, are you enthused by the kind of return of local investors that you've seen to the mutual fund business in the last year or so in markets like India? What's your outlook on that front?
Well, certainly if you look at last year's equity markets in India, up over 30%, you have to be pretty enthusiastic about that. We're fortunate at the Principal Financial Group that we have very strong equity performance, very strong debt performance, fixed income performance, that is. So again, we remain very enthusiastic. I think, again, when you look at India, savings rates of over 30%, that's the envy of the world, to think that you've got a populace that is setting aside that much of their disposable income, saving for long-term retirement savings. There's certainly a mix, as you know, between purchases of real estate and gold, other commodities, as well as bank deposits. I think the next evolutionary phase of the investment landscape here in India is likely to be publicly traded equity, publicly traded bonds, where a potential yield could be more beneficial to those savers, converting savers into investors and certainly that's a big part of what our strategy here in India.
You mentioned when you were talking about India's potential that you might be looking at growing your business via acquisitions. Do you have that strategy lined up for India as well? So you're looking at something to buy in the asset management space, or maybe, like you said, you're doing insurance only in the US, but maybe even an entry in insurance here?
I don't envision us in entering the insurance markets here in the Indian market, at least in the foreseeable future. But we are always inquisitive about opportunities to make acquisitions here in India, whether it's around asset management or distribution that would support asset management. Certainly our advisory platform that we're rolling out has the potential to grow via organic growth. We certainly are looking for the right acquisition, but having said that, we feel very confident about a strategy that would allow us to continue to grow in an organic manner.
All right.
In addition to that, of course, we want to roll out new products as well.
All right, fair enough. You did lay out right at the beginning that, because of growth in markets like India, you feel confident about moving ahead and investing money in 2015. So I'm going to sort of try and end this interview with a question on really what you would identify as the top 3 challenges facing global business leaders like you, or even the global economy, as you want to put it, through the course of this year.
Okay, that's a really very insightful question. I'd say number one is around the world, we have to be very careful around cybersecurity and ensuring that we're creating a safe environment for investors in order to save and know that those dollars are being properly protected. And we make significant investment in technology. So not only the back offices, not only the front office of being able to exchange business with our customers, but also making sure that we operate in a very secure manner. The second is around regulatory. We need to make sure that there's not an overreach around regulations, making sure that we have a market that is fair to the consumer and also would attract distribution partners as well as manufacturers to do business, and that applies all around the world. And the last one is to make sure that we're deploying our capital in the most efficient manner. Again, when you look at countries like India and China and Latin America, where you have growth rates of upwards of 5 or 6 or 7%, that's always going to attract a lot of capital. We have very patient capital. We make these investments for long periods of time. We've been in business now for over 135 years. And again, we look to continue to those kind of investments in these new emerging markets like India, like China, like other parts of Southeast Asia.
But is capital difficult to come by, Dan, given the amount of money that seems to be sloshing around in the global financial system over the last couple of years?
I don't think so. I think actually the capital markets are wide open. If it's strategically aligned with your business, I think both issuing of debt as well as issuing additional equity, as long as it aligns with your strategy and you're able to consistently deliver to the shareholders, I don't really see that there's a significant limit at all to capital.
It's interesting you did not, in those 3 challenges, list the deflationary pressures that we're seeing play out in Europe right now. That seems to be top of mind of many market men. So I'm just curious as to why, as a business leader, you don't think that is a huge area of concern or a cause for concern, or at least definitely a big burden on 2015.
Well, again, I think the question really in running a business has more to do with what's going to transpire over the next 3 to 5 years. We may see some deflationary pressures throughout Europe. We could see low interest rates in the U.S. that impact certainly capital-intensive businesses. We could see equity markets go sideways or have more volatility. All of that's interesting. It makes good news, but at the same time, we're long-term investors. We're looking over the course of the next 3, 5, 10, over the course of the lifetime of the savers. So again, deflationary pressures only cause us to pause and recognize it, but not to be distracted by it that would prevent us from making an investment or serving the needs of our customers.
All right, fair enough. Dan, appreciate you finding the time to speak with us here on CNBC TV 18. Enjoy the rest of your trip to India.
It's my pleasure. Thank you for having me.